In my last video, I talked about why you're not actually behind on investing, but of course that begs the question, what should I actually invest in, especially if I'm starting from zero? So in this video, I'm going to show you the exact portfolio I would build if I had to start investing from zero today. This is going to be the exact order I would invest my money, what accounts I would use, and what assets I would buy. And later on in the video, I'm going to show you a mistake that a lot of beginners make, but it can have drastic changes on the long-term health of your portfolio. So let me know where you're at in your investing journey. I would love to know, but I will say this video is definitely geared more towards the beginner investor or someone who just needs a little less risk in their portfolio. Now that we have that out of the way, let's begin with your foundation. This video will work for you whether you have $100, $1,000, or $100,000, but it won't work for you if you have no money for random expenses and you keep having to pull out of your investments. So step number one is to have some money, I'd say at least $1,000 within a high yield savings account for your emergency fund. Now that that's done, we can start with the core of your portfolio, which is going to be the NASDAQ 100 index with a 50% weighting. I haven't really talked about core and satellite positions on this channel yet, but this is how a lot of seasoned investors set up their portfolios. But back to the NASDAQ, the index consists of the 100 largest non-financial companies listed on the NASDAQ exchange, and it's very similar to the S&P 500 if you've ever heard of that, except it's about 400 companies less, and it's a little more tech heavy. The reason why I'm choosing this over the unbeatable S&P 500 is because since the NASDAQ was created, it actually has outperformed the S&P. So over the last like 20, 30 years. The top 5 companies are Nvidia, Apple, Microsoft, Amazon, and Google. And what's cool about a lot of these indexes is they're really not too expensive to be in, and they also rebalance themselves every so often. This is the reason why a lot of indexes tend to outperform regular people, because they have a strict set of guidelines that they follow, and whenever a stock breaks one of those guidelines, they're out. For example, there are several different types of securities that are allowed on the NASDAQ, like regular stocks and ADRs, but REITs, special purpose acquisition companies, and quote unquote, when issued securities are not eligible. I'm looking at a PDF of their methodology, and just scrolling down, there's some other things like a security must have a 3-month average daily traded value of at least $5 million, and a security must have a free float of at least 10%. This is just basically total outstanding shares minus shares that are restricted or locked in by founders, insiders, or governments. This PDF goes super in depth. There are 16 pages that I will link, but one important thing that it does highlight is its reconstitution and rebalance frequency. So reconstitution is whenever it goes through itself and it chooses stocks to remove and it chooses stocks to add. It does this once a year, and rebalancing is whenever it goes through itself and it decides the weighting on each stock, and it does this quarterly. So again, this is our core with a 50% weighting, and if you're in America, you can invest into the NASDAQ with QQQ or QQQM. They are literally the exact same thing made by the exact same company, except QQQM is like 0.05% cheaper, so you might as well choose that one. Moving on to our next holding and our biggest satellite position, we're going to have a 20% weighting in SCHD. This is the Schwab US Dividend ETF, and its goal is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index, and it's done a pretty good job of that. It's another low-cost index fund, and historically it's done pretty well, averaging around 10% a year, all while having around a 3.3% dividend yield. Now, I chose this for many reasons aside from the fact that I'm a dividend growth investor at heart, but let's get into those. Now, the main reason I'm buying this is because of their methodology. Anytime you buy a fund, you're essentially just buying a methodology, but the way that SAHD is set up, it essentially counteracts the NASDAQ and it picks up where QQQ may fall short. If we take a look at the bottom of this screenshot, it assigns a 4% cap per stock and a 25% sector cap. What this means is if they own some stocks and they go parabolic, at some point they're going to start trimming those positions, taking gains off the table, and then putting that money back into other stocks that meet their criteria. Couple that with the fact that they only choose the highest dividend payers amongst their first initial screening, and you have a vastly different portfolio than the QQQ. This is what has caused it to have a 20% weighting in energy that has been going crazy recently and has been sending SCHD skyrocketing. All of this while the QQQ has been plummeting because of this whole SaaS apocalypse thing going on. Any stock remotely related to software has been dropping, but SCHD has been holding strong, and this is what I mean by diversification diversification. A lot of newer investors think just because they're invested in hundreds of different companies, they're diversified, which I guess to an extent is true. But what are you going to do whenever your portfolio drops by 20%? This is why we're doing this. Not only are we investing in different stocks in different industries, but we're also investing in different methodologies. One that goes with momentum and one that kind of goes against momentum. And on top of all of this, you're getting a pretty solid growing dividend that can take the place of bonds, because even though it is an additional asset class, I'm not a fan of, and they're not going in this portfolio. With this, we have a pretty ironclad portfolio, but we still have 30% that we can work with, and this is where I come to a crossroads. You might have noticed that none of these funds hold REITs, and even though the 2020s haven't been that good for the REIT market, supposedly they have outperformed over the past 30 years. Because of this, I wanted to put some money into V&Q, which is the largest REIT fund in America, but since 2006, it's only gone up 34%, and over the past 10 years, it's only averaged 1.19% growth. But then I found RAAX with a 5-star Morningstar grade. It is a real asset ETF that holds real estate, gold miners, MLPs, infrastructure stocks. I even saw cattle futures, but their whole goal is to maximize real returns while seeking to reduce downside risk during sustained market declines. And over the past 5 years, they've averaged about 16% returns. I chose this because I wanted to add diversification into more asset classes outside of just stocks. I'm going to give this one a 10% weighting. I think this is a really cool fund and does a fantastic job of accomplishing our goals. And with that, we have the bulk of our portfolio done. We've played it pretty defensively, and I think we've shielded it from many different angles. I think this portfolio alone would perform really well, but I don't want to leave gains on the table. And with the remaining 20%, I'm going to take shots at making more money. The first 5% I'm going to put into Bitcoin. I made a whole video talking about it, but I'll summarize some of my points. It's one of the largest currencies in the entire world. It's decentralized. Multiple countries are stockpiling it. In America, there are currently bills being proposed that would help Bitcoin, like the Bitcoin for America Act and the Clarity Act. That would actually help all crypto, not just Bitcoin. The Clarity Act would add rules and guidelines that would help regulate crypto and make it safer. I know crypto's scary and hasn't been around that long. Of course, none of this is financial advice, but that's why I only gave Bitcoin a 5% weighting in my portfolio. But if you're not comfortable with this, you can replace this with a 10% holding in the Aerospace and Defense ETF XAR. This is an equal weighted portfolio among different aerospace and defense companies. And this is always going to be one of not just our government, but pretty much every government on the planet's biggest expenses. Here's a picture of their top holdings. And because of all of this, they've managed to average around 19.6% every single year over the past 15 years. That is ridiculous. But at this point, whether you have an extra 10% or 15%, we're going to allocate the rest of our portfolio to individual stocks with 5% holdings in each. Now, my only criteria with these is that we choose high quality compounding machines that give us continuous returns year after year and that continuously outperform the market. The only problem with this is that it's incredibly vague, and this video is geared towards beginners. I'm not expecting y'all to read 10Ks or look at balance sheets or really do any type of fundamental analysis. So what is something that's beginner friendly that we can do? We can look at other people's portfolios. More specifically, we can look at super investors who have a consistent track record of outperforming the market. I've taken the liberty to do some of this work for you, and I've pulled up 3 portfolios of 3 current super investors: Chris Hone, Chuck Ockrey, and Dev Cantasaria from Valley Forge. You can look up their performances if you want, but the reason that I pull this up is because I want to see which stocks they have in common and just see if anything stands out. The first thing that I notice is that each of them have a form of either Visa and or Mastercard in their portfolio. So this is going to be one that I'm eyeballing. And honestly, I've already done research on this company and I have a whole video about it. I think Mastercard is an incredibly high quality company and I definitely want it as an extra 5% weighting in my portfolio. But even if I didn't know any of this stuff, seeing Mastercard and or Visa shared across all of these portfolios is a really good sign. And honestly, for the sake of the video, is enough to pull the trigger on it. The next 5% weighting is another incredibly high quality company that I really haven't talked much about on this channel yet, but that's S&P Global. This is 11.5% of Chris Hone's portfolio and almost 21% of Dev Cantasaria's portfolio. And if I'm thinking about this from a beginner's perspective, they made the S&P 500 and the S&P 500 is never going away. Of course, they also grow fast and have high margins, and the ratings portion of their business is extremely important, but all of that to say, this is an incredibly high quality company. And with the last 5% in my portfolio, I'm going to put that in a wide moat infrastructure stock. These are the kind of stocks that Chris Hone loves. I honestly couldn't decide between the two, so I'm going to say either GE Aerospace or ASML. You choose. Both of these companies are miles ahead of the competition, and they either have virtually none or literally no competition. They both have install-based contracts, so not only are they getting recurring revenue, which investors love, but because these contracts, they're making money if people are building more of their products or if they aren't. It can definitely be challenging sometimes, but I really try to not repeat myself, at least in certain aspects. I will say this isn't how I currently have my portfolio set up, but I think it's great for people whether you're young and just getting into it or older and need to catch up, and I think it avoids a lot of beginner mistakes. I just wanted to make a good, actionable video for newer investors, not only to piggyback off my last one, but also since it was asked of me. I hope y'all appreciate it. I hope y'all got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.